Hi, good afternoon. You're watching Money9. I'm Kartik Malhotra. Well, India unfortunately is in kissing distance of 275,000 new COVID-19 cases a day. State after state going into curfews and lockdowns. Just a few minutes ago, we saw Delhi Chief Minister Arvind Kejriwal also announcing a 6-day lockdown in Delhi. Since morning markets have been going down, a constant decline, Sensex was down about 2%. What should be an investor strategy right now in this pandemic, especially as the pandemic enters the second wave? Joining me to discuss this and help all our viewers, investors, stay top of their investments is Feroze Azeez. Feroze is Deputy CEO, Anand Rathi Private Wealth. Hi, Feroze. Thank you so much for joining us on this Money Masterclass again. Tell us, what should be an investor strategy at a time like this?
Thank you, Karthik. I think, to my mind, when things are like this, and there is some degree of uncertainty from a health standpoint, especially in the second wave, I think I'm lesser worried, unlike in the first wave, because the variables were importantly unknown the last time around. Here, there's been 1 year of clear understanding of what we're dealing with and what kind of economic impact it can bring. So, point one, I don't think there's much to be done during this next 1 month period when we will uncover the second wave. Point one. Point two is that this time around, whatever correction is going to happen is going to be a logic based correction rather than a fear based correction. What do you mean by a logic based correction? Is not sell it all, it is sell what will get impacted. That's why you see banking as a sector is down 17-18% from its peak, but Nifty is just about 6% lower than its peak. So this time around, it's going to be a logic-driven correction. So remember that. So the buying opportunity is not going to be as deep and as lucrative as it was the last time. So to answer your pointed question, Karthik, to my mind, a person should not be too worried. If he or she has less than 50% in equity, and if you are fortunate to get a good entry level because of this interim fear, you should use that opportunity to scale up your equity above 50 and up to 65.
Right. So, Feroz, what level do you think is going to be the right entry point? Because right now markets are hovering around the 47,000 levels, and you said there's going to be a logic-based correction this time. We are not going to see the kind of crash that we saw last year. So, what do you think is going to be a relevant entry point for somebody who's a fresh investor or wants to add more equity, like you said?
See, what happens is at any levels, not numerical integers, but you should look at its relativeness from the peak. So if peak of Nifty, for example, that's the number I'm very familiar with, 15,350 odd. Today we are at 14,350. So that's a 1,000 point correction, which is about 6.5%. So what you should do is, if you wish to deploy money for any correction in the multiples of 5, 10, 15, 20, you should keep adding a large component of the money which you wish to transfer from debt to equity. So to answer your pointed question, Karthik, 5% lower than the peak is 1,000 points from 15,300, 15,000 where we are today. So if the market falls another 5% and another 5%, so another 10% correction, if things go very southwards, cannot be ruled out.
Right. And do you think this time around, Firoz, like we saw last year, gold was soaring because people considered gold to be a safe haven? Do you think people are going to hold gold again, and not just retail investors, but overall, do you see gold prices going up again in the midst of the second wave of the pandemic?
The answer is no, to my mind, Karthik. And the logic is, last time when gold had its share of rally, the entire globe was equally impacted with a fear, which was the reason of the correction. This time around, every country and every economy has a different impact by COVID, and different fear levels are there for different countries. So it's not that everybody in the globe is worried. Everybody has discovered countries with lower population which can achieve herd immunity by vaccination, vaccinated 20 crore people out of 32 crore. They've already got to 60%. That's because they have 32 crore people and that kind of infrastructure. UAE, kind of a country which is not so large, has 1.5 crore population. So what I'm trying to get to is gold would have surged to its new levels only if the entire globe was equally worried, which was the case the last year.
Right. And do you think the more aggressive investors who are already more invested in equity should now add a little bit of debt also to their portfolio? Or do you think it's good to be aggressive and continue with your equity investments all the way?
See, I think if you're aggressive inherently, then there's nothing much to worry. It's about what you have decided. Stick to what you have decided. Don't get swayed by the recent latest biases. So point one I'm making is if you're 80%, stick to 80%. If 80 has become 90 because of market rally, bring it back to 90. If you're decided 65 for yourself, which is what we've decided for our clients, because of the market rally, if it went to 75, it's time to bring it back to 65. So staying what you have decided is important. And it's not about trying to keep the markets have done worse off and with your recency bias, which is what it is called, you reduce your equity or increase your equity. Stick to what you've decided and don't get swayed by the current market environment unless there's something fundamentally wrong. And I don't think we think that there is any long-term change in what the Indian economic growth progress is going to be.
Right. So Firoz, also I wanted to understand. In fact, we had discussed this last week also. But just for our viewers to get some clarity, for somebody who's entering mutual funds right now, do you think a balanced advantage fund is the right choice because it's going to buy more on dips, buy more equity on dips, and partially sell it as markets go up?
Yes, Kartik, I think there are two kinds of people who are in the initial phases of their investing career, right? So what happens is you've not collected enough money to apply so much mind on the overall portfolio basis. So that's from a retail investor standpoint. Definitely, it's a very good product. But an HNI who has a few crores or tens of crores is not going to rely on only a outsourced single product or a group of products to do this job. So if you are a new investor and if you're beginning and you're a retail investor and your market volatility worries you, then definitely this is a very good product because it sells as the market goes up and buys as the market comes down, which becomes very difficult for a human being to emotionally do. We generally do just the opposite of the right thing. Sell when the markets have gone down and buy when the markets have gone up. And if you see all the mutual fund flows, it always happens. Last month was the largest SIP collection, right? That should have ideally been the last March's number if you wanted to do the right thing as a group of investors, as Indians.
Right. And are debt funds on your radar at all? Would you advise that at all to anybody, or even the government bonds or the gilt funds as we know them? What should be the strategy for somebody if you want to look at safer investments right now? Do you suggest these debt funds at all?
Fund category or any category, don't look at products individually. You have to always look at them as a group of products, right? Especially in debt. There are three categories you can buy from: medium-term funds, dynamic bond funds, and short-term funds. So all of them have a role to play. It's not either or. So we generally buy 4 to 5 schemes who have a complementary nature in them. So you would buy 2 dynamic bond funds, one short-term fund, one medium-term fund to complement the risk of the dynamic bond fund. So I think, Kartik, to answer your pointed question, is debt supposed to be an integral part of portfolio? Especially in India, it has to be, because you still are at interest rates of 6.25% on a 10-year basis, even to Government of India. So they have to be an integral part. Unless the interest rates come down to 3-4% in India, it will remain an integral part. Second, in debt, the most important thing to keep in mind is don't buy standalone products. You need complementary products. If you buy a higher risk product, if you buy a higher interest rate risk product like a dynamic bond fund, complement it with a short-term bond fund, both of them will balance the risk. So dynamic short-term funds and medium term, these three categories for
Right.
usage in terms of portfolio construction.
Right. So Feroze Azeez there, as always, with great insights into the world of investing and what you should do as an existing investor or a new first-time investor. That's a wrap on Money Masterclass. Thank you so much for watching. Goodbye and have a nice afternoon.